Africa handles more mobile money than any other region on Earth. Not close. Nearly 3/4 of every mobile money transaction on the planet happens on this continent. Now try this. Send money by mobile wallet from Lagos to Accra. Until very recently, that payment likely had to take a detour through a bank in London or New York before it could arrive next door. The continent that invented mobile money still struggles to move it across its own borders. Here is the operational reality facing any business or individual trying to move money between two African countries right now. Domestically, mobile money in many African markets is faster and more reliable than in almost any other region in the world. Cross a border and that same transaction can suddenly take days, cost significantly more, and pass through intermediary banks that have nothing to do with either country involved. That is not a hypothetical inconvenience. It is a direct tax on intra-African trade, remittances, and the exact kind of digital commerce this channel has spent multiple episodes discussing. So how big is Africa's mobile money dominance really? And why does crossing a border still break it? Key point 1. The scale of Africa's dominance is genuinely extraordinary. According to the GSMA's State of the Industry report on Mobile Money 2026, global mobile money transactions reached just over $2 trillion in 2025. Sub-Saharan Africa alone accounted for $1.432 trillion of that, 66% of the entire global transaction value, and roughly 74% of global transaction volume. Africa also holds 52% of the world's registered mobile money accounts, close to 1.2 billion of them. This is not a story about Africa catching up to a global trend. Mobile money as an industry effectively originated in Africa, and this continent still defines what the global industry looks like. Worth noting, honestly, only around a third of those registered accounts are actually active in a typical month. A real usage gap sitting inside the dominant story. And a reminder that big numbers and full financial inclusion are not the same thing. Key point 2. And yet, crossing a border still breaks the system. Despite that dominance, most cross-border payments between African countries still route through correspondent banks based in the United States, the United Kingdom, or the European Union. That routing adds 3 to 7 days of settlement delay, additional intermediary fees, and reduces visibility into where a payment actually is at any given moment. This system was built for a world where direct banking relationships between African financial institutions barely existed. A trader in Lagos needs to pay a supplier in Accra. Both countries have some of the most advanced mobile money ecosystems on the continent. And yet, until recently, that payment's most likely path involved converting Naira to dollars, routing through a correspondent bank outside Africa entirely, then converting dollars to cedis on the other end, adding days and cost to a transaction between two neighboring economies. Key point 3. Africa already built the fix. This is the part of the story that deserves far more attention than it gets. The fix already exists, and it was built by an African institution. The Pan-African Payment and Settlement System, known as PAPSS, was developed by Afreximbank specifically to solve this problem. It settles cross-border transactions directly in local currencies without requiring a dollar or euro intermediary, and it nets out balances between countries rather than moving the full transaction value every time. PAPSS is already live in 12 countries. In February 2026, PAPSS and OnAfrique, a Pan-African digital payments network, launched what's believed to be Africa's first wallet-to-wallet cross-border payment corridor, connecting Nigeria and Ghana directly. A user can send Naira and have the recipient receive cedis, with no dollar conversion step at all. That same month, Kenya's instant payment network PesaLink plugged into PAPSS as well, connecting more than 80 Kenyan banks, fintechs, savings cooperatives and telecom operators to a continent-wide settlement network, now linking over 240 financial institutions. Key point 4. So why isn't this solved yet? Here is the honest, less comfortable part of this story. PAPSS has existed for years, and its rollout has been genuinely slow. One detailed analysis of the system's progress put it bluntly. Several central banks have treated PAPSS more as a symbolic achievement to announce than as core infrastructure to fully implement. Regulatory fragmentation across Africa's regional economic communities continues to slow the harmonization needed for the system to work seamlessly at scale. This is the same pattern this channel has flagged before, with AFCFTA's digital trade commitments and with the Abuja Declaration on Connectivity. Africa keeps building the right frameworks and the right infrastructure. The gap consistently sits in the follow-through, in the months and years after the launch announcement, when the harder, less visible work of actual implementation is supposed to happen. So what does this actually mean for how governments, businesses and investors should be thinking about Africa's payments future? The strategic insight. Here is the reframe I want every regulator, investor and business leader watching this to sit with. This was never really an infrastructure problem. Africa built its own cross-border settlement rail years ago through an African institution specifically designed to remove dependency on foreign correspondent banking. The problem has been operationalization, getting central banks, regulators and financial institutions across dozens of countries to actually plug into it and use it as the default, not the exception. There is a real cost to leaving that gap open. If African-built rails like PAPSS don't get operationalized fast enough, something else will fill that vacuum, and it may not be African-owned. Foreign fintech aggregators and stablecoin-based payment corridors are already emerging specifically to solve the same cross-border friction PAPSS was built to solve. If that vacuum gets filled by non-African infrastructure instead, this becomes a genuine sovereignty story, not just an efficiency one. So here is what actually needs to happen next. The practical takeaways. 1. Central banks that have not fully operationalized their PAPSS connections should treat that as urgent infrastructure work, not a completed initiative. Symbolic participation does not move the underlying numbers. 2. Track new wallet-to-wallet corridors beyond Nigeria and Ghana as the real adoption signal. 1 working corridor is a proof of concept. 10 working corridors is a functioning continental payment system. 3. Regulators across ECOWAS, EAC and SADC should prioritize licensing harmonization specifically for cross-border mobile money, since fragmented rules remain the biggest cited drag on faster adoption. 4. Governments and regulators should watch how quickly stablecoin and foreign fintech corridors grow in African cross-border payments over the next 2 years. Rapid growth there is a direct signal that African-built rails are losing the window to become the default. 5. Investors evaluating African fintech should weight interoperability and cross-border settlement capability heavily, since that is where the sector's own dominant position is currently most exposed. Conclusion. Africa built the mobile money industry the rest of the world is still catching up to. And it built its own fix for the one part of that system that didn't work: cross-border payment. The technology is not the missing piece anymore. Whether it gets fully operationalized over the next few years is the number that will actually decide this story. Thank you for watching. Don't forget to subscribe and turn on the notification. And I will see you in the next video, which is showing on your screen now.